Hello everyone, this is Mark with Semantics Trading with your daily recap. So today we did see the market rally again today for the best 3-day gain since May 27th, which was massively led by tech and consumer discretionary. The Nasdaq led the S&P as risk assets had higher relative strength. Tesla beat expectations yesterday. Although the negative outlook was overstated, it still had very bad earnings. But regardless, it led the market posting about gains of 10% on a day. The Treasury yields dropped lower with the 10-year falling under 3% with the ECB rate hikes of 50 basis points, which is the first time that ECB has raised rates in a decade. And in the after hours, Snapchat reported poor earning results, and as a result, Meta and Google sold off in sympathy. Now, if we take a look at the current and future general activity indexes, new orders are declining due to less demand, and in July, overall declines in regional manufacturing activities and current activities and new orders remain negative, while shipments rose slightly. Firms continue to indicate overall increases in employment and widespread increases in prices, and the indicators for future general activities and new orders remain negative, suggesting that there is an expectation for overall declines in the next 6 months. The prices paid and prices received declined for the third consecutive month, but price increases are still widespread. If we take a look at the order book, liquidity is still at its 2022. Liquidity is at its 2022 highs, which is a good sign. But we do need to see it increasing, as the thicker the order book is, the harder it is to move the market. The issue is that low liquidity makes it easier for the market to break down with any little selling. It works both ways, but we have seen lack of liquidity and a very thin order book, and as a result, any little bit of selling this year has seen massive drawdowns in the market. And the higher the liquidity essentially means that there's more players participating, and right now, as liquidity is relatively low, it shows that there is a lot of fear in the market. So it is hard for the market to gain a footing without decent amount of liquidity. We do see the SPX up in 10% in the last month, and the fund managers overall have the most cash in the last 21 years. And it is, we do have lower growth and profit expectations, and sentiment is quite bad. Interestingly enough, despite recession fears, we do see participants selling defensives and buying growth. So there is an argument that since we are so well informed these days with data spreading rather quickly on the internet, people are expecting a capitulation first before they enter and take risk. And they go based off this historical data, and they think it would align perfectly, and they expect a certain amount of drawdown before we bottom. But like I said, that's it's only should be used as a reference, but it's not necessarily an absolute thing, because there's always many factors that come in. Let's just say if we get a consistent surge in speculators, you'll have more liquidity that comes back in the market, and the market can grab a proper footing. And if we take a look at this data by S&P Global, we are seeing a freeze in overall home ownership as affordability becomes further unattainable, as mortgage rates have massively risen, and housing prices are still making new highs. We do see longer dated VIX futures trading above pre-COVID levels, which reflects that there is still risk aversion as there is a significant amount of players still hedged. The implied volatility is still over pre-May levels across tenors, according to Goldman Sachs. Realized volatility has been materially lower for equities, rates, and credit. Forex volatility has stayed high, and commodity volatility has spiked given the geopolitical situation. We do see long-short ratios very low relative to the past on U.S. mega-cap tech. So this gives us room to potentially relever once the time arises. On this chart, we can see that global macro hedge funds are heavily short equities more than during the height of COVID. As you can see, the bearish sentiment is at, you could argue that it's at a peak. And we haven't seen this typical capitulation in outflows from equity flows like in the past. And in fact, outflows have only really began while sentiment is at extreme pessimistic levels. If we take a look at the cross-border equity indicator, it generally, when we see extremes in the last few decades since 1987, we've seen extremes in the last 4 times. We've seen strong returns in the markets in the following 12 months, and we do see global net issuance at the moment, which is based on buyback and equity issuance, reflect record net demand for equities from corporates. And in the long term, we may be able to see some positive returns based off this data point, but whether we have truly bottomed yet or not, it's highly questionable. But we can argue that in the long term, the risk reward does make sense for U.S. equities at these current prices, betting on the upside, that is. And there are some potential risk events coming up in the near term, such as August 10th CPI print and the earnings results that we are in the middle of. And based off these results, it appears that negativity was overstated, as seen with several crucial earnings such as Netflix and Tesla, which actually rallied despite having poor earnings. And I think it is very crucial for mega cap tech to overall deliver significant EPS growth and hold up margins. And if we were to see a significant print lower in CPI closer to neutral, then I think it is possible that we may see a peak inflation, peak Fed hawkishness narrative that will be in favor, as then geopolitical risk will have appeared to have subsided. And this will likely result in lower hikes and perhaps rate cuts mid next year, as the Euro-dollar futures curve suggests. And with that being said, that is it for the recap. I want to thank you all for watching. Be sure to check out a link if you want to subscribe and join a Discord. And do check out the Twitter page and the Substack if you want to be more informed or updated. And I want to thank you all for watching. This is Mark with Semantics Trading, signing out.